Hello, today I'm going to be covering part 1 to changes in partnership. So what this video will be covering today is we'll do an introduction into Goodwill, exactly what Goodwill is and how does it work, and then I will focus on the first point here, the admission aspect to the changes in a partnership, which is basically focusing on what happens if a new partner joins the business. Okay, so Goodwill is basically once a company has established themselves and they have a loyal customer base, or they have a strong brand image or reputation, or they are very profitable, etc. Anything that drives success for a business has value. Okay, that business ultimately has a value, and that value is goodwill. Okay, so a company that started from scratch and that have built themselves up and that are well known, that is called goodwill. Okay, the premium value to that business. Okay, other than looking at its assets and liabilities, you've got to look beyond that. Okay, when you value a company, you don't just value a company based on assets and liabilities, you value it in terms of what it can bring you in the long term. And for businesses that are looking to sell, they will charge a premium goodwill. In accounting, goodwill is a non-current asset. Okay, and there are two types of non-current assets. There are tangible and there are intangible. Tangible are those that are physical, and intangible are those that are not physical. And goodwill is a non-physical, non-physical, non-current asset. Okay, like patents and trademarks, etc. They are also not physical. Okay, so goodwill is the reputation of a business in the form of an asset, in a non-current asset that is intangible, and it usually comes up in accounting when a business is for sale or has been sold. Okay, otherwise you won't generally see it on the books. Okay, there are certain reasons for that, and I won't go into that in detail in this particular video, but for you guys, what you need to understand for AQA is goodwill is what is goodwill, how is it treated in the financial position, and what we'll talk through this video and the next couple of videos as well all relates back to goodwill. So that's the focus of this. So I mentioned earlier, if we jump down to this point at the bottom, okay, so a company was bought for 835, though the financial positions, assets and liabilities valued the business at 745. What is the value of goodwill? And the difference between 835 and 745 is £90,000. That is the value of goodwill. Okay, someone could have easily paid 745,000 for the asset, for the business, sorry, but they paid more. And the reason why they paid more is probably because that company is valued higher. Maybe it has a strong customer base, or they have been very profitable, or they have a very good product, etc., etc. And that is basically goodwill. Okay, and that is the difference between the value of a company as a whole, i.e. the 835, and the book value of its net assets, which is 745. It's the difference between the two. Okay, that's basically, in a nutshell, what goodwill is. So as I mentioned, this video is going to focus on what happens when a new partner joins. Okay, before any partner joins, the existing partners, they all have to be on board. If a new partner joins, what happens is they will bring in capital, and some of that capital will be given to the existing partners. Okay, you can't just, when it comes to a partnership anyway, you can't just join a company and expect to receive a slice of the pie. Okay, you can't join a company and expect to receive profit straight away. You will be expected to join a company, bring your capital to the table, and expect that some of that capital is going to be used to pay existing partners. So all existing partners, they will benefit immediately from a proportion of the goodwill value. Okay, so if you take, there are three partners, partner A, partner B, and partner C is the new person joining. C brings money to the table, and he or she will give some of that money to A and B. So as a result, partner C's capital goes down. The reason why it goes down is because some of that cash is given to the existing partners. It's a bit like, I'm joining you guys, thank you for letting me join your company and receive profit straight away. I'm going to pay you, basically. Okay, you are paying existing partners for letting yourself join the company. Okay, so partner C will pay partner A and partner B as a payment, as a premium for joining an established company and reaping benefits immediately. Okay, so the new partner is charged a premium rate of goodwill, and how do they pay for that premium? Well, their capital is reduced. We'll refer to an example in a moment. Obviously, new partner brings in money, they join the business straight away, they will benefit immediately from profits. And when the business decides to sell, the new partner, they may also benefit if the company is sold on again and again and again. Okay, every time there is a change to a partnership, if there is goodwill, then we need to account for it, and you'll see in a few moments time how exactly we do that. So I'll go through an example, look at the theory in a bit more detail. So we have a question on the left hand side. We have Norman and Oliver, and they are sharing things equally. They both have £75,000 in their capital. Peter is the new person joining. Originally it is a 50-50 share. However, after Peter joins, it is going to be 40-40-20 split. So before 50-50, now it's 40-40-20. We need to account for goodwill, and exactly what do I mean by that we'll have a look at in a moment. So goodwill has been valued at 40, so the existing partners feel that the business is worth an additional 40 because of their hard work and effort. Okay, what we need to do is deal with goodwill within capital accounts, because that's where it is dealt with, and you have a goodwill account. So let's have a look at what we need to do. Okay, bear with me, ignore that for a moment. I need to just delete that and restart from fresh. Okay, so just ignore that for me for a moment. Okay, so what I would like you to do is, if you can continue listening to the video, let me go through an example, and there are plenty of other examples that you'll have an opportunity to have a go at. But I think it's important that you listen up, understand what the process is. Once you've grasped that, then you can have a go at the next question. Otherwise you aren't really, you aren't really going to know what you need to do. So I've done a bit of a breakdown, and you'll notice that I've used the same format for all the questions. Okay, simply because it makes things very, very easy. So we have, when you are tackling a question like this, put the partners up, all of them, whether it's before or after the changes. So we have N, O and P, Norman, Oliver and Peter. We have the old, so before any changes took place, Norman and Oliver, they were the only two partners there. However, afterwards it's changed to 40, 40 and 20, with Peter now there. So Peter wasn't there before, he is now there after the change. Okay, goodwill, we have £40,000 of goodwill. So we have a goodwill account, and then we have 3 capital accounts, 1 for each partner, and goodwill is accounted for in here, as well as each capital account, and I'll show you exactly what you need to do. So the first thing is and this is the process for every single question on changes to partnership. You take the 40,000 and you divide it, you split it based on the old ratio, so before any changes took place, and before it was just these two people, 50-50. That is a £20,000 split, so we're going to put 20 there, and that is going to the two people that were there before, which is Norman and Oliver. Okay, so that is a debit. What I need to do now is I need to do the credit entries, but before I do the credit entries I need to put these opening balances in. 75 for Norman and Oliver. So Norman and Oliver. Okay, and that's your balance BD, and that's your balance BD over there. Okay, so debits, credits. You'll know what happens at the end. Okay, the easiest is to follow the process have a look at the overview of the account, and then you'll see, oh, that's what he's doing. Okay, if I explain to you now it might not stick. It'll be best if I do a recap at the end of this scenario. So all we've done is 40k split at the old ratio, debit, debit, credit, credit, Norman and Oliver. Peter's not involved because he wasn't there at the old ratio. We do the same thing based on the new ratio, so 40 divided by 40%, 40%, 20% split. Okay, 4 times 4 is 16, so 16 twice, and then 8. Okay, and this is going to go to, I'm just going to copy that over, this is going to go to all of the partners including Peter because he's there after the change. So these are credit entries, you put the debit entry there, so that's your double entry transaction, Goodwill, Goodwill and Goodwill. 16, 16, and the rest of it is 8. Okay, so we have, where are we? Credit entries, debit 1, debit 2, debit 3. These two, they add up to 40. They should always add up. If they don't add up, we have a problem. You've got to create and eliminate. Create, this is important, and I always, when teaching this particular topic, I always say create Goodwill on the debit side. You create it at the old ratio, i.e. before the old ratio, and you eliminate it at the new. Okay, you've got to create it and get rid of it. You've got to cancel, they've got to cancel out. Okay, and you do the double entries, and you'll see in the next 1 or 2 minutes exactly what are we doing and why are we doing it, which is the most important part to this question. Okay, what I'm going to do is just very quickly balance this off. 95, take it across so you can see the bigger picture. 95 minus 16 is 79, and BAL CD there, and we have BAL BD. Okay, now it just so happens that these are all the same, i.e. Norman and Oliver, so I'm just going to copy that over to make things very quick for myself. Okay, before I look at Peter, I'm just going to show you what exactly is going on here. So Norman and Oliver, they were there from before. They've taken on this new person here. Okay, look at their capital balance. They started off with 75, and now they've ended up with how much? 79. Okay, so what's happened to their balance? Has it gone up or down? It has increased. It's gone from 75 to 79. Okay, and the reason why it's gone up is because Peter, who joined, he has paid them 8,000 between the two. So he's given 4 to Norman and 4 to Oliver. So as a new partner joining, this is the general rule of thumb. If you are a new partner that is joining, expect that you need to pay the existing partners a share of goodwill, and the only way you calculate it is 40 split old, 40 split new, do the double entry, and then you have this. You can see what's happening with these two. Now with this one, the question is focusing on just Oliver's capital account. All of this still useful, still some, a good example to go through. Obviously what's missing in the question, they don't want us to do this, they just wanted a quick tick box question. However, if we say, for example, this person brought in, I don't know, £20,000, well, if you balance off the account, balance CD above, and we have 12, and we have BALBD 12 there. Okay, think about it. How much money did he bring in? He brought £20,000 to the table. How much does he have now? After joining, he's got 12. The reason why he has 12 is because he's given up 8. He's given up 8 to these two. That is the principle of admission. Okay, someone joins, they pay. However, these two will benefit. Existing partners benefit, new partner loses out. Peter's not actually losing out. He's losing out in the short term. He's got a little bit less cash, but in the long term, he will receive profits. He's now a partner, and he will receive 20% in profit. Okay, so what I'm going to do is, like I said, for this particular question, I thought it would be best to go through goodwill and capital account, so you can see double entry there, etc., etc. For this particular question, Oliver's capital account now has 79, so your answer is B. Okay, what I'm going to do now is look at the next question. Sorry, before that, a little bit of theory just to recap, and then next question, and I'll signpost you from there on. So the method is, the value of goodwill is established in the accounts, okay, but it must be eliminated, i.e. you create and you eliminate. Okay, it cannot be left in the books. And create the goodwill at the old ratio and eliminate it at the new. So create goodwill, split on the old, debit, and eliminate on the new, on the credit side. And you can see that is now eliminated there. Okay, so just a quick summary on what I've already discussed. Okay, so if you want to, I think what I've done, and I'm just going to have a quick look. What I've done for this question, for the next one, is I've just done a goodwill account and a capital account for Andrew. Okay, because the question is looking at Andrew's account. You're more than welcome to do all the T accounts. However, I'm just going to focus on Andrew. Okay, so feel free to pause the video if you want to have a go at the question. Otherwise, let's look at another example. Okay, so I'm just going to check everything is correct because I've typed this up beforehand. So we've got 50,000 goodwill. They're both equal before, so before is 1 to 1, and afterwards Colin is joined in 2 to 1, with Colin having the smaller share, so 2 to 1. Okay, so it looks like we're all good. So we're going to follow the same process. 50 at the old, split 50-50, £50,000, 50-50, okay, on a 1-to-1 basis. So we have 25,000 split. Okay, and that is going to go to the old partners, A and B. So A capital and Barry's capital. So we have debit entries there. Obviously we're looking at A's capital only, so we have a debit and a credit, and that has come from goodwill, so that's our detail in the account. Okay, so short question there. That is one part of the question done. We have split goodwill on the old ratio. Now we need to split it on the new, so 50 split 2 to 1. Nice and easy figures. 20,000 and 10,000. And A, B, C gets the smallest portion. I'm just going to copy the detail over. Okay, so again, debit, credit done. These are credits, so the debit is going to be here, and Andrew is going to get 20, and that's come from Goodwill. Okay, so Andrew, is he the partner that's joining, or was he there before? He was there before, okay, because Colin is the one joining. So if you look at the capital account, I know we don't know what his opening balance is, but if you look at the account itself, has it increased more or decreased overall? Okay, so we have a 25 increase and a 20 decrease. Overall, there's a £5,000 increase to his capital. Why is that? It's because he is an existing partner, and the new partner, Colin, has paid him. Okay, Andrew and Barry have been kind enough to let Colin into their partnership, so Colin has had to pay Andrew and Barry, and he's given Andrew 5,000, and he probably would have given Barry 5,000 as well. Okay, because Barry was an existing partner. Obviously, Colin's capital would have reduced in the short term. In the long term, he's now a partner, and he is, getting half compared to the other two. Okay, so we're looking at a 40-40-20 ratio. Okay, let's look at another question. I think I have got quite a few questions here. Okay, so just going to scroll down for a moment. Let's see what I've done here. And okay, so this question, this is the information, the data, and then we have a Goodwill account that we need to do and a capital account. So what I'm going to do is I'm just going to leave it there. Feel free to pause the video at this moment in time if you want to have a go at the question yourself, and you can use the T accounts that I've done here. That's all we need to do. We don't need to do all of the capital accounts for all the partners. We're just focusing on Goodwill and Uma's capital account. Okay, so let's have a look at the answer to this. So we have two partners, Sue and Tom. Uma's joined the partnership. She's brought 25,000 to the business. Before Uma joined, there was a 60-40 split, with Sue having 60 and Tom having 40. Thereafter, it's on a 50-30-20 split. Okay, so what I need to do is I need to change my figures here. I've actually made a mistake, I think. Have I made a mistake? No, I haven't. Oh, that's all fine. Let's just check the figures anyway. Sue, 60, Tom, 40 before. After, Sue has 50, Tom has 30, and Uma has 20. Goodwill is 30k. Okay, so we need to do Goodwill, we need to do Uma's account. Let's have a look. I'm just going to move that a little bit over there. Okay, so first thing I would do is I would put in the £25,000 that Uma brought in. Now you can do this as balance BD, or you can do it as bank. I'm going to do it as balance BD. Okay, so balance BD, she bought £25,000 in. That is your opening capital figure. Okay, now we need to do Goodwill at the old, Goodwill at the new. Goodwill is 30, we split 60, 40, 6 times 3 is 18, so we're going to have 18, and the difference is 12, 30 and 12, add them together. Okay, so we have Sue and Tom at the old ratio, 60-40, Sue and Tom, and now we have, okay, and that adds up to 30. We use the 30, we split on the new ratio, 50-30-20 split. So we have 15, we have 9, and then we have 6. I'm going to copy the detail over. Sue, Tom, and Uma capital. Okay, so let's do the double entry. So we debit these and we debit goodwill and we credit their capital, but we don't need to do their capital, so you can do an imaginary capital account somewhere. We have credited goodwill and we need to debit the capital accounts. So again, you can do an imaginary Sue and Tom. As for Uma, I've got it up here, so credit, debit. Okay, they add up, which is a good sign. 15 plus 9, 24, plus 6 is 30. Uma's capital account, let's get it balanced off so we can see exactly what's going on. 25, take it across, difference above, which is 19, and that is your balance carried down. Okay, so what's exactly going on here? So we have Uma who's joined the business. Let's just do the balance BD. Uma's joined. If I ask you the question, how much money did she bring into the business, you'll tell me 25, because that's what it says over there. How much did she start with? 25. How much does she have once she has joined the partnership? She has 19. Why has her capital reduced? The reason is she has joined an established business, and to join an established business and to receive profits immediately, for a partnership that is, you've got to pay a small premium. Okay, so she has paid £6,000 in premium. 25 she started, she's ended up with 19, she's paid 6, and we can see that there. Okay, that 6 will probably go to Sue and Tom. Okay, it will go to them. Sue will probably get a bit more than Tom because Sue has a 60% share and Tom has a 40%, so Sue will benefit a little bit more. Sue will get 60% of that and Tom will get the difference. Okay, there is another question coming up, a full question like I've done from the first question, a goodwill and all 3 capital accounts with an admission. Okay, so you'll get to see how that works out and how it pans out in full. These questions are just the way they've designed them. They don't want to see everything, they just want to see part of it. Okay, so that is another question done. Okay, we have some true and false questions before we move on to a retirement question, which I might do in part 2 actually. So let's summarize. So Sue and Tom have each paid money to Uma when she joined the partnership. True or false? Doesn't make sense to me. Sue and Tom were there from before. Why would they pay money to the new partner? Doesn't make sense. It's the other way around. Okay, Uma would have paid Sue and Tom. Uma would have paid them, not the other way around. So the answer to the first one is false. Question 2. The goodwill of 30,000 is kept in a separate bank account in accordance with the Partnership Act. Okay, goodwill is a book transaction. It is a paper transaction, i.e. it stays on the books. The transaction itself, goodwill on a financial position, is a book transaction. It's a T account transaction. Okay, it's a paper transaction. It's not an actual transaction. Okay, the only time it is a transaction is when the business is sold and they receive the money, and that money comes into the bank. Okay, now what they could be talking about, 2 things here. They could be talking about the goodwill itself. Well, that sits on the financial position. It's not in a separate bank account. Okay, when the business is sold and they receive the 30,000, even then it's not in a separate bank account. Okay, and the Partnership Act 1890 doesn't say anything to do with that. Okay, so it is a bit of a silly question. The answer is false. So to clarify, goodwill, it is a paper transaction until a company is sold. When a company is sold, then whoever has sold the business, they have the money in their bank, whichever bank that may be. The partnership, the new owners to the partnership, okay, or the new individuals who own the business, well, they've paid a sum. They have paid a sum of money okay, and the goodwill for the new individuals for that business, the goodwill value will stay on the FP for them. Okay, now that's a whole separate story in itself, and I don't want to get into that detail. Purpose of this video is focusing on goodwill and capital double entry transactions, so I'm not going to do much detail, so I'll stop there. Number 3, Uma has paid a premium for 20% share of the profits. That is correct. So we had false, and this one is true. Uma has paid 20% of the goodwill value, okay, and she has paid that to Sue and Tom. With goodwill valued at 30, Sue and Tom will each have 15,000 extra profit this year. Okay, that is false, and the reason why it's false is because we don't know from the scenario what the profits are going to be for next year. We don't know. If we knew that, we could have worked out the split, but we don't know what that is. So again, I think they're trying to trick you here with saying 15 split between two people, 30. Maybe there's something there with that, but it is a false question. These questions aren't the greatest, but they do get you to think. Okay, so that is the end of the first section, which focuses on the admission. Okay, what I will do is, I don't want to put an hour or over an hour video together and then realize there are some faults somewhere in the video, hence what's happened to me earlier today. So I'm going to leave it there, and feel free to keep an eye out for part 2 to the changes in partnership, which is all going to be to do with goodwill and capital accounts. I hope that's been useful, and thank you for listening.